I'm going to talk for a minute about the fundamentals of stock market investing so that you can look at it and decide if it's something that's worth your time and your effort. So when you're thinking about investing in the stock market, you need to decide if you're going to be an active or a passive investor. A passive investor is someone who doesn't actively manage their portfolio. They buy things like mutual funds, market index funds, and they're holding for the long term. That's what I recommend for 99% of people to do. That's what I do myself. I take advantage of my company's 401k and things like that. And I'm just buying and holding for the long term, not even going to touch that money for decades. Because the stock market has historically averaged about 10 or 11% per year. So if you can just do that on a regular basis, just invest, then over time, by the time you reach retirement, you should be able to generate quite a bit of wealth. So that's, like I said, that's something that I think 99% of people should do, if not 100%. But you can also be an active investor. That's what I do as well. I take a certain amount of my money and I'm an active investor. And that's someone who is consistently looking at their portfolio. You're actively managing it. You're valuing businesses. You're looking at stocks, options, things like that. And that's something that requires a lot of time, a lot of analysis, a lot of energy, and it's not something that I would recommend to people unless it's absolutely a love and a passion of yours. For me, it is. I love doing it. It's like a game for me. I love diving into the financial statements of a business, valuing the stock, and just searching for that great deal. So I'm looking for a stock that is trading for less than what I think it's worth. So I would say I think it's worth $100 a share. It's currently trading for $60. If I'm confident in my analysis, then that's a great deal and I'm going to buy it. And I'll give some examples later of some companies that I have bought that I've done quite well with over the last couple of years. And just also real fast, I'm not a professional investment advisor. I'm not a professional registered stockbroker. These are just things that have worked really well for me and have worked well for a lot of other people, but they may not work for you, so you should consult with a professional. So I'm getting that disclaimer out of the way. So when I'm looking at a company and whether or not I want to buy a stock, I'm looking at a few things. First off, I'm looking at the face value if it's a good company, and then I dive into the numbers. So whether or not it's a good company, I'm looking for a company that has identifiable competitive advantages. So a competitive advantage could be like the company has great brand name recognition. So like Coca-Cola. Everybody knows Coca-Cola. It's a household name. It's going to be really hard for someone to start up a cola business and come in and steal some of Coca-Cola's market share or some of its customers, just because they're so popular. Even Pepsi, a lot of people prefer the taste of Pepsi over Coca-Cola, but Coca-Cola still dominates Pepsi in sales just because it's such a household name. Another advantage could be a patent or a trade secret that the company has. So like a pharmaceutical company who's developed a new drug and they have a patent on it and it can't be imitated, or at least it's going to take a few years for imitators to be able to copy it. So that's a great competitive advantage. Another one could be just the sheer size. So like Walmart. Walmart's so big, they have so many distributors, so many stores that they can afford to sell their products for very cheap. And so in order for someone to be able to compete with Walmart in that regard, they would have to get so big that, it's not likely to happen. So you want a competitive advantage. Now, the mistake that a lot of amateurs make is that's where they stop. They see a business that sounds good, they've heard of it, they like the company, and so they buy it. So I've heard things like, well, everybody uses Facebook, so I'm going to buy some Facebook stock. Or people are always going to have to use gasoline, so I'm going to buy, this oil stock. Those are terrible reasons to invest in a stock just based on the face value like that. Because while it may be true, that everybody uses Facebook, the stock itself could be very overvalued. It could be a terrible buy and a terrible decision. So, I'm going to name a few companies. I don't recommend or not recommend any of these companies. It's things that you should dive down deep into the numbers and make the decision for yourself. So the first number that I look at that I think is most important when I'm analyzing a business is the return on invested capital. The return on invested capital for a business basically is a measurement of how well the managers are using the money that's been invested into the business. So, for example, say you start a business, an ice cream business, and you invest $50,000, and say the first year you make $75,000 in sales. And so the net income, you've invested 50, you've sold 75. The net income, we won't look at taxes or anything, or 25,000. This is just a simple example. So in order to calculate the return on invested capital, you're going to take that net income of 25,000 and divide it by the investment of 50,000. So that would be 50%. That would be the return on invested capital. You're going to want to look that up online. Sometimes there can be some other numbers that go into it, but that's very simply, in a nutshell, what return on invested capital is. So I'm looking for ROIC of a business for the last 5 to 10 years of consistently being, at least around 10% per year, because that tells me that the company's management does an excellent job of investing, of using the money that's been invested. And so they're running the business well. It's going to continue to grow, foreseeably into the future. So you can find, by the way, all the numbers that you need for these things you can find online from the financial statements, the income statement, the balance statement, cash flow statement of a company. You can find those at Yahoo Finance, MSN Money, Fidelity, things like that. And so that's where you find these numbers. The next 4 numbers that I look at are all growth rates. So I'm looking at how well a business is growing so that I can know, hopefully, how well it's going to grow into the future, so I can know if it's a company that I want to buy into. So the 4 things I look at are, first off, sales growth rate. Each year, I want sales to be growing. You find that in the income statement. It's the top line. I want sales to be growing from year to year, because that tells me that the business is going to continue to grow. People are continuing to buy the company's products, and it's still getting more popular and more well known. Those sales growing consistently is very important. So again, the last 5 to 10 years, I'm looking for an average growth rate per year of hopefully around 10% or more. That's a great sign, especially for a well-established company. Startup companies may be a lot different. They may be a lot steeper. I usually don't look at startup companies personally. I'm looking for more established companies. So the next thing that I look at is earnings per share growth rate. The earnings per share is just simply, how many earnings have been generated per share of stock. So say you have a company that generates $100,000 in earnings, and the earnings is the after-tax net income. That's generally what earnings mean. Say they have $100,000, and say they have 100 shares that are just divided up amongst people. That's going to be $1,000 earnings per share, because again, there's 100,000 in earnings, 100 shares, so that's 1,000 per share. That's the earnings per share. Now, it doesn't really matter what that earnings per share number is. What more matters is the growth. So one company could have $1 earnings per share, the next could have 5. The 5 is not better necessarily than the 1, because they could have a different number of outstanding shares of stock. So what's more important is the year-to-year growth. So you want to look at the earnings per share and just see that from year to year it's growing, hopefully again around 10% or more, because that tells me that if everything else is good, that my stock is going to keep gaining value in the foreseeable future. And so the next thing that I'm looking at is equity growth. So the equity of a business is basically what would be left if they were to sell everything, liquidate the business, sell off all their debt, or pay back all of their debt. What would be left? So just like with the house, if you owe $100,000 and your house is worth $125,000, if you were to sell it, you would have $25,000 in equity. That's basically what the equity is. You find that on the balance sheet, the total equity down there towards the bottom of the balance sheet. I'm looking for that again to be growing, because that tells me that the business is becoming worth more and more, and that's very important. Last thing that I look at is the free cash growth rate. So the free cash is basically how much cash is left in the bank for the company after all of the cash has been used for operations. So how much cash they have on hand. It's very important to me for a business to have good free cash and that it's growing over time, because that means to me that they're going to have money to reinvest into the business or to pay out in dividends, and also just that they have a margin of safety. If things go wrong, that they have that kind of reserve fund, you could call it, to take care of operations going forward. So again, you look at those things. You can look up online how to calculate these things, but those are just the fundamentals of what I'm looking at for a company. And this, by the way, is what's called fundamental analysis. A lot of people do technical analysis, which is basically they're just looking at the price of a business and moving averages and things like that. To me, that's a waste of time. Some people make money at it, but I'm more interested in the fundamental value of a company. So once you've looked at these 5 numbers, you can kind of see the health of a company and how it's growing. Then you need to determine how much the stock should be worth. And see what it's currently trading for to see if it's overvalued or undervalued. So the way that you do that is what's called a discounted cash flow analysis. I'm not going to go into how to calculate that. You can find calculators online and how to calculate that, but a discounted cash flow analysis is basically going to tell you, based on what I think the company is going to earn in the foreseeable future, in the next, X number of years, this is how much I think it should be worth today if I'm demanding a certain return on my investment. So I'll explain a little. So you're going to need 4 numbers for that. The current earnings per share. You're going to also need to know what you think the estimated future earnings per share growth is going to be. The way that you're going to look at that is you look at what it's been previously. So say the earnings per share growth has consistently been 7%. As long as there aren't any big changes in the business this year, that if I'm looking at consistent 7% for the last 5+ years, then it's reasonable for me to assume that they're going to continue at around that 7% in the future. So you want to know that. You also want to know the price earnings ratio, what you think it's going to be moving forward. Price earnings ratio is basically how much more investors are currently paying for a stock than what the earnings are. So if earnings per share are $1 and the stock's trading for $10 per share, then the PE ratio is 10. So you want to look at what it has been, try to determine what you think it will be in the future, find out what the industry average is. So if all the companies in your industry, the PE ratio average is 40, say, but the company you're looking at is 100 is the PE ratio, that's a bad sign. That may mean that it's well overvalued, that the stock is overvalued. And then the last thing that you want to determine is what your minimal acceptable rate of return is. You're going to need that to do your discounted cash flow. So I'm looking for 15% a year minimum. That's kind of what I expect and what I want. If it's a more risky business, like a startup, I'll probably demand more, like 20 or 25%. So anyways, you do that discounted cash flow analysis, and that should give you a number of what the stock should be worth today. And then once you're confident in your analysis, you just look at what it's currently trading for. So just a couple of examples of businesses that I've invested in that I still have. So Buffalo Wild Wings, I bought back in January of 2014. Again, I don't recommend any of these. You have to do your own analysis. But I invested when Buffalo Wild Wings was trading for about $142 a share. I did all of my analysis, and I determined that I thought it was actually worth, after I did my DCF analysis, that it was actually worth more like $180 per share. So I was confident in my analysis, so I bought, a bunch of that stock. Today, last I checked, Buffalo Wild Wings is trading for $191 per share. So I've made over 30%. I've also done that with Apple. I bought in about a year ago when it was in the 90s. Currently, I think it's about $128 per share, so I've made over about 30% in that as well. I've also done it with Netflix. I made 20% with Netflix in just a couple months, but then I determined that I thought it was overvalued after it went up about that 20%, so I sold. But Apple, Buffalo Wild Wings, a couple of other stocks I still have. So you want to look at that and just again, once you do that analysis, determine whether or not it's over or undervalued. Now, why would a stock be undervalued in the market? Why would people be paying less for the stock than what it's really worth? There's a lot of reasons. It could be going through just some unpopularity. Maybe something came out in the news about the company and it's really not that big of a deal. But people just freak out about little things like that and they assume other people are going to sell and so they sell and so the stock goes down. So it could be something like that. It could also, just be that there's a lot of irrational exuberance about the stock and so it's actually trading, it's more popular than it should be, so it's trading for too much. So there's a lot of reasons why, a stock might not be selling at the time for what it's actually worth. Some people just, have maybe done their analysis a little bit different than you. And that's why it's at a different price. And so it's really important that you're confident in your analysis. And that comes with time. You start to gain confidence in your decisions. The first couple times it can be scary, but you want to also be patient is what I would say. The first time you buy a stock, you're going to be looking at it pretty closely. And if it starts to go down, you're going to start freaking out. And you have to learn some patience and some confidence in your analysis. That happened to me with Buffalo Wild Wings. After I bought it, it went down a little bit. But, I was patient. I trusted what I had looked at. And so I just waited it out and it eventually went up. But so these are things that you kind of gain with practice over time. I'll also say that, there have been times where I have guessed wrong and I've lost some money on stocks, but over time, just using that patience, I have done better I've made more money than I've lost, and I've been able to beat the market returns for the last couple of years, like I've said. So it's something that with practice, you can become good at. Now, I'll just say if you've made it to this point of the video and you're just completely bored, but you've lasted it out anyways, and you just can't stand the idea of looking at all these numbers, then again, I wouldn't try this out. I would be a passive investor. But if you're interested, it's a great thing. You can find again these numbers and calculate these numbers just from the financial statements. And you can also, there's some websites that will have you pay a monthly membership fee and they'll calculate everything for you, the ROIC, the average for the last 5-year growth rates for sales, EPS, all of that stuff. But you can figure it out yourself, and it's actually not that hard once you learn where to look and once you learn how to calculate it. But again, if it's something you're interested in, I would check out Rule Number 1 by Phil Town. It's a great book. He explains all of these things really well. He explains a little bit more about how to calculate these things, where to look, and just some other things. It's probably the best book that I've bought on stock market investing, and I've used some of the things that he talks about in there to make some good money. Most of what I learned from getting an undergraduate degree in finance, but it's really, you don't need to have that degree. This is something that just with a little bit of practice, and if you have a knack for this kind of thing, you can actually do pretty well. Again, I wouldn't use the bulk of your money to be an active manager unless you're working on Wall Street or something, just because it's very hard to consistently beat the market. I've done it for the last couple of years. That doesn't mean I always will. So I don't want to be too risky and use all of my money to do that. The majority of my retirement money, I'm investing in mutual funds and passively managed things. But it is fun if you love it. If being an active manager is what you love, then I would definitely try it with some of your money. Just if you don't have a lot of money right now, just budget a certain amount. That's what I had to do when I first got started. And it took some patience. I wanted to get started so bad, but I didn't have any money. I was a college student. And so I just budgeted, it was like $100 a month. I just started putting aside in an Ameritrade account. And by the time I had enough money to buy my first stock, that's when I started doing it. And I've just continued to do that ever since. And so the other thing that I would say is you're going to want at least $1,000 or at least $700 or $800 to buy a stock at first. You're going to buy that much, $700 or $800 at least worth of a stock, because anything less, it's not worth it because of the trading fees. And so Ameritrade or Scottrade or E-Trade, these things, they charge a certain amount. It's like $7 or up to $10 every time you make a trade. So every time you buy or every time you sell, they're going to take that $10. So you want to be playing with a little bit more money, upwards of $700, $800 at the very least. Now, these days, I'm looking at a couple of thousand in a stock. Just because if you say you spend $100 on a stock, you had to spend $10 to buy that stock, and when you sell it, you're going to have to spend $10. So that's $20. That's the fee that these brokerages take. It's, you know, a fee for doing business through them. And so $20, you know, out of 100, that's 20%. So you're going to have to make more than 20% on your investment to even break even and start making money. So start saving up a little bit if you want to do this. And again, once you get into that, you know, 700-800 or more range, that's when I would start looking at buying your first stock. So hopefully that helps someone out there. Hopefully it helps you decide if you want to try this out. Again, I would try rule number 1. This is a very basic strategy, the things that I've been talking about. You can get more into options or shorting or put call options or straddles or spreads, all these weird things that I don't do a lot of. I might get into it more one day, but I'm just a value investor. I love finding a stock that's undervalued and buying it and just waiting for an explosion in value. That to me is just super fun. So you want to do what is fun for you and what you feel like you're good at. So hopefully that helps.